Welcome to Enlightened Wealth Strategies, the podcast where insight and knowledge meet opportunity. Please join us as we navigate the world of finance, discovering actionable strategies to help you achieve your personal financial goals.
With decades of combined experience, we're here to shed light on the topics that matter most to your financial well-being. Whether you're accumulating, preserving, or distributing your wealth, this is the place for you.
Now let's dive in and start your journey to financial enlightenment.
Welcome. Hello, James.
How's everything?
Everything is well.
Well, today we're going to have another podcast session here with Enlightened Wealth Strategies, and we're going to talk about alternative investing.
And who do we have today as a guest?
Well, I don't want to give that away quite yet, but, I wanted to just mention real quickly, we've been taught about investing, that the universe of investing is stocks, bonds, cash, real estate. But we know, or at least elite investors know, that's only a small portion of what we can possibly direct people to investing in. So there's a broader choices of that are out there that we can help to improve returns, and while reducing the risk, well, also losses too, which is of course the risk associated with it. But we really want to also, in light of where the markets are, we want to protect from the inevitable event of a downturn. The markets, what goes up comes down eventually. Yeah, it goes back up, but we want to try to minimize that impact. But there are really four components or jobs, or or whatever terminology we want to look at, with regard to our alternative investments. Number one, we want to see where and how we can generate higher income. Number two, we want to reduce overall risk by diversifying a broader base of strategies that are associated with alternative investments. And number three, we want to enhance the long-term growth through these various opportunities that maybe also provide a little bit more upside than a traditional investments might. And probably one of the more important things, because of recent history, is protecting individuals' purchasing power from inflation. And predominantly what inflation causes is currency devaluation or debasement. So again, it's portfolio construction within the alternative space, but the goal is mainly to maximize those returns, and as you said, reduce the risk or mitigate those risks. Again, it comes to, when we as advisors and practitioners, and even, individuals, investors, they know this. They know that through their experience, that most of the time, advisors have advised them to have a balanced portfolio, right?
Yes.
The 60-40, 60% in equities, 40% in bonds and cash is most widely known and accepted.
Yes.
But that over recent years, or even the last decade plus, that hasn't always worked out so well. Now, that's number one. That may be the number one lesson or mistake that has been made. The other one is, what is diversification? Diversification oftentimes was
small cap, mid cap, large cap, growth, value, blend.
Yeah, but now you got all those funny boxes that you could use in Morningstar. Okay, now that's deemed to be diversification. Not so much, right? And then the other component of it is that we want to make sure that people are not falling into that old adage is, well, I'm going to, the market goes down, I'm just going to hold because I bought into it. So they become married to and emotionally attached to an investment. So what alternatives allows us to do is get away from the traditional investing, at least a small portion of their portfolio, and we get into investments that are, as you may used before, it's uncorrelated.
Right.
So anyway, I'm going to use an example before we bring in our guest. So endowment funds, the university endowment funds, particularly the Ivy League schools, Are you aware of what their investing is when it comes to domestic stock and bond market?
Oh, less than 10%.
That is true.
Most of the time they're investing in the alternative space.
Yeah, predominantly. And again, it's not something that we can compare and contrast an individual investor to, multi-billion-dollar endowment funds. But that should give us a little bit of an idea of maybe what we could be doing for individuals and what individuals may want to consider doing. The bigger issue is how much of their overall portfolio, including their retirement accounts, because as we both know, working with individuals and small business owners that have 401k plans, you don't have the ability to necessarily do that. But if that's predominance of their overall wealth, then we may be able to do something for them on the outside with their individual accounts to get a percentage of it exposed in the alternative space. So that they do have uncorrelated investments from the traditional market, so that when they do take a downturn, they have a foundation that's going to be protected. And that's not going to be overall impacted to the level that it would be in the investments that they have in those traditional markets. So one of the questions you may have asked me once before was, what percentage? I don't know. That all depends.
I know it depends on the client's risk tolerance and what they're looking to accomplish.
And where they are, what type of an investor they are. And some people would be happy with 5%. Others would be happy to put a zero after that, make it 50%. I don't necessarily espouse that. I think somewhere between 10 and 20%, but it depends upon the individual at the end of the day, and what we can do with them. So having said that, what types of alternative investments could possibly be out there, Jim?
Real estate, farmland, which I just learned about earlier. I'm drawing a blank.
Private equity.
Private equity.
There's all kinds.
Yes.
Everything. But today we have a guest who is going to talk about a form of real estate investing.
Awesome.
Oh, I would like to bring in Scott Farrington of Hamilton Point Investments.
Hello, Scott.
Welcome, Scott.
Hey, good afternoon. How are you?
Very good. How are you doing?
Very well. Thank you.
And we want to thank you for taking the time out to join us today. And before we get started, I'd like to allow you to tell us a little bit about yourself and the fund that I know that you have a number of different funds, but if you want to speak specifically about one, but if you just want to get into some generalities about the overall management group, let's do that. Let's start there.
Okay. And is it okay if I share a couple slides here?
Sure.
Perfect. So Hamilton Point was started in 2009. We were started by Matt Sharp and Dave Kelsey. They are both commercial real estate underwriters from Wall Street. So they got their start back in the early 90s, working with the big banks on Wall Street, and ultimately, worked their way up the chains, and then started left and started their own companies. They were very successful. Dave Kelsey had gone out and done some hospitality as well as multifamily. Matt Sharp focused solely on multifamily with friends and family and some small institutional money. So what we do now, let me digress. They were running their own companies up through the end of 2006. I guess they actually through 2009 when they merged their two companies. But they stopped buying real estate at the end of 2006, which I found very interesting because the markets got way overheated. Valuations got over their skis. 2007, banks became, very open and were basically loaning money for any amounts on any type of real estate. So as you can imagine, that created a huge overvaluation. So while they were out there looking at properties, nothing made sense economically from a financial standpoint. So they ended up basically sitting on their hands until the Great Recession, or the bottom of the Great Recession, which was the end of the middle of 2009. So they joined forces. They had not worked together previously, but they ran in the same circles, were friends, knew each other. They decided to start the Hamilton Point Company, which we now are running. And so we're a very experienced manager of multifamily. We've acquired over 32,000 apartment units and now over $3.5 billion worth of multifamily. We have had 14 full cycle programs. 7 of them have been funds, much like I'm going to be talking about now. 7 of them were 1031 Delaware statutory trust structured 1031s. So our average weight on them returns are about an 18% IRR. So you kind of think of that as an annualized rate of return of 18% while the investors were in the funds. So our first 2 funds, once they joined forces in 2009, from 2010 to 2012, we had 2 different funds, Funds 1 and Fund 2, come out. And those 2 funds lasted about 4 years, and they full cycled and returned a 14.5 and a 14.6 respectively annualized rate of return to those investors. So now that's a total return. So part of that was received in cash, or distributions along the way, and then the remainder was in capital appreciation as we sold the properties. Then we had Fund 3 come out in 2014. That fund was, again, multifamily, as all these funds are. That fund delivered a little over 18% annualized rate of return, and that was on average, about a 3.5-year hold period. Fund 4, I would say our Fund 4 is our outlier. That fund, we started in 2016. We started to liquidate it and COVID hit. So it dragged that fund out a little bit because when COVID hit, as you can imagine, we had, I want to say, probably 10 months where the banks were pretty much frozen. Not much in acquisitions or dispositions took place really globally. And so that fund actually lasted or went into the 5th year. So it was a 5-year hold period, and it returned about a 14.3% annualized rate of return. So not much lower than our first 2 funds. But that fund really should have been a high teen, maybe even a low 20 IRR had we been able to finish our liquidation before the COVID hit. Fund 5 was a 4.5-year hold. That fund did almost 17% annualized, and then Fund 6 and 7 both did a little over 21% annualized. So our weighted average IRR for all of our 7 funds that we've taken full cycle, those are a little bit over 18% annualized, 18.3 specifically. So did you want me to talk about kind of the current market situation, or more about the fund and structure?
I think looking at the current market, let's look there and we'll come back to the current fund after that. How's that?
Sure. No, that's fine. So in the current market, there really is an opportunity in multifamily for many different reasons, of which one is that prices, because interest rates went up. Let me kind of give you some background. As interest rates went up, a lot of institutions, the smart institutions and the smart investors, started pulling money out of real estate because they understand the correlation or inverse correlation between interest rates going up and valuations of properties coming down. So there's a lot of institutional money and smart money that pulled off to the side. And basically, we're waiting for interest rates to start coming back down so that they could reinvest. So as interest rates come back down, valuations start to go up because it becomes easier to borrow, cheaper to borrow, as well as the relation to the yield of the property to interest rates. So that's a kind of a complicated scenario. But point being is that there's a lot of dry powder on the side of the market that's just starting to come back into the marketplace. So when interest rates did start to go back up, or did start going up in the first part of 2020, what happened with multifamily was anything that was being built, was going to be completed, but anything that wasn't shovel in the ground ready, basically got shelved. So what we've had, because once COVID hit, interest rates became so cheap during COVID that it was very inexpensive to borrow. Institutions, smart investors, just private equity firms, they were looking for investments that performed even through a pandemic, and multifamily was one of those asset classes. So since we have a lot of underlying currents that are going to continue the need for multifamily, one being the lack of affordable housing, another being the high price of housing, it's forcing a lot of people to have to continue to rent. And as I mentioned, our growing population, I don't know how long it's going to take us to be able to catch up as far as our need for affordable housing for individuals across the U.S. That being said, the smart money started to build when money was real cheap in 2020, end of 2020, beginning of 2021. I'm sorry, through 2021 and into the beginning of 2022. A lot of new construction started in multifamily space again because it performed so well through COVID, and then subsequently after COVID, rents were really pushed up a lot. So the performance of those asset classes did really well. Subsequently, we sold pretty much all of our assets that we had purchased before COVID. Funds 4, 5, 6, and 7 actually sold into that strength. We would say that's probably the peak of the market. But having said that, all that new construction is now coming to the market, or has been over the last year and a half, and will continue into the first half of 2025. So what that's created is a whole lot of new supply, which is creating a scenario where you have owners of real estate, the managers of these multifamily properties, that are having to give away a lot of concessions to get people, to entice people to come into their property and to rent from them. And so what that's doing is, if you're giving away stuff, you're lowering your cash flow. So your NOI, your net operating income, goes down. Well, that all contributes to the fact that valuations in multifamily and a lot of real estate, short of single family homes, a lot of these valuations have come down, and it's more difficult and more expensive to borrow debt to either purchase or build. So a lot of new construction has stopped. And as interest rates were going up, as I'd mentioned, any new plans for properties basically went onto the shelf. So what's happened is you had a whole lot of new construction that's now coming to the market, or has been over the last year and will continue to the first half of next year, which is creating a little bit of oversupply, which is an opportunity to go out there and buy at lower prices. But after that oversupply is absorbed by that continuing growing population, there's virtually nothing coming after it. So then you have a huge scenario where you have a lot of need, a lot of demand, but you have very little supply. And owners in that situation, owners of the multifamily in that situation, would be able to go in and really start pushing rents much more rapidly than they historically would have been able to. So you kind of think of historical growth of rents being somewhere in the 2 to 3% range. Right after COVID, it was, when we saw lease over lease, so somebody moved out, the next lease person came in, that was a 20% gain, 15 to 20% gain on some of those leases, because there was so much demand. But having said that, when there's all this oversupply, they've been having to, basically incentivize people to come in. But once that demand catches up, the owners of the multifamily are then going to be able to, again, more aggressively, not post-COVID aggressive, but surely in a high single to low double-digit numbers on your lease growth rate. So that's really where there's a huge opportunity right now to be able to go out there and buy properties at low pricing, because there's high interest rate, there's less bidders at the table. The institutions are starting to come back in. We saw, what did you see? Blackstone bought a $10 billion portfolio earlier this year. KKR bought a $2.3 billion portfolio. early this year. This is all of multifamily, mind you, and you're starting to see transactions within this space in the multifamily starting to pick up a little bit. But there's still great opportunity for us to go out there and buy properties at 20 to 30% discounts from peak pricing, and at 10 to 20% discounts to replacement cost. And we're talking brand new properties. So, unfortunately for some of the owners and some of the developers out there, when interest rates started to go up, they either didn't have the forethought to put long-term fixed rate debt on their property, or in the situation of a developer, they ended up having a construction loan converting to a permanent loan, which when they had underwritten what that permanent loan was going to be, interest rates were so low they had no idea that interest rates were going to more than double. So right now you have entities that either had a short-term fixed rate lock on their mortgage or on their debt that's now coming to market, and the banks are saying, okay, you can refinance, but it's going to be more than twice the debt service cost, or the amount to service that debt on this loan. And we're probably not going to give you as much money or debt, allow as much debt, because the feds have come in and said that the banks need to tighten up on how much they were lending to each property. So that's really where there's the opportunity right now, is with these financially distressed sellers of virtually brand new properties, again, at 20 to 30% discounts. And we haven't seen pricing this low since the middle 2000 teens, so 2014, 15, 16, because of the current financial situation. But it's not going to last forever. Now, interest rates ultimately will come down over the next couple of years. And that'll give us an opportunity to ride that way, because as interest rates come down, valuations go up. So that's that, and then the continued growth of the demand for multifamily, and then also with more institutional money coming in, and then with debt coming down, you have smaller potential buyers that can use debt to come in and bid as well. More bidders at the table. When somebody's selling a property, the higher the price as well. So we're getting in at the low. We really are at a low over the last 6 to 12 months in pricing a multifamily compared to replacement cost.
So Scott, but what you're telling us in summary is that you're taking advantage of what the market is offering and trying to step in and purchase some of these available multifamily units. And how does that, by doing this now, obviously, how much is it contributing to the overall rate of return of the current fund?
Well, I mean, our objective with this fund is a 14% or better annualized rate of return. The current fund is paying a 6% distribution. We will, let's see,
and is that 6% annual or monthly?
We pay on a quarterly basis. So the 6% is on an annualized basis. Okay. So you get a quarter of that every quarter.
Okay. And so the fund itself, you're looking for an annualized overall return of 14%. Also, the other question I had for you is so that people will better understand where are these housing units, in what states in the country are they operated?
Well, that's a great question, and it's actually quite an important question. Now, historically, and I believe going forward, that will continue to stay in what are stereotypically called right-to-work states. Some people would say they're more red than blue, as far as politically speaking, but more conservative in regards to the different state regulations.
So they're Middle America, is what you're saying.
Yeah. So you kind of think of the Mideast. The Southeast, and then the Midwest. So kind of think of North Carolina over to Texas, and then Ohio over to Nebraska. Okay. And that kind of, area. So that's our target market. Those tend to be, again, more conservative states that give landlords more rights. You don't end up like you can in California or New England, where you have somebody file for bankruptcy and they have a kid in school and they basically squat on your property for 18 months and don't pay you a dime. We want pretty much the opportunity to have, if the client, the renter doesn't pay us in 30 days, they have a 30-day rent, 30-day late notice. And if they don't pay us in another 30 days, then we evict them. And the sheriff shows up and, all their stuff's moved out to the sidewalk. Obviously, we're not trying to
do that.
Evict people that are having hardships. We work with everybody, but you obviously have some people that try to game the system, and you have to have an ability to protect yourself against those.
Okay, we have a couple of more minutes. Jim, do you have any questions you want to ask?
The funds, usually when you open one, how long does it last?
How long are we raising money for it?
Yeah. The maturity of the fund.
Yeah,
itself.
so usually about 8 to 12 months, depending. And this fund started the end of July. So my guess is, into the first quarter of next year, maybe early second quarter. I mean,
and then it'll be closed to
ultimately who's sending in money and how quickly it's coming in, but it does speed up as we get towards the end of the fund.
Okay. And then it's at some point it closes and shuts down after you sell all the properties. Is that correct?
Yeah. So as we're raising money, we're acquiring properties. We want to stereotypically hold a property for about 3 years.
Okay.
And then we're going to be looking for the exit. So it's typically a kind of a 4-year average hold period, if you want to think of it from that perspective, of which the investor is getting 6%. May be important, maybe not, but it's a very tax advantage 6%. You're not actually taxed on it as it's coming out. And then we're looking for at least another 8% in capital appreciation per year that the investor has invested. So those totaling up to 14 each year.
All right. Great. All right, Scott, we want to thank you for taking the time out to talk with us about the Hamilton Point funds. And we may have you back another time in the near future. And between now and then, maybe we'll have a different environment in which to discuss things. But
sure.
we want to thank you again. We really, really appreciate your time.
Always happy to be here. If you have any additional questions, any of your clients do, by all means, just give me a call and we'll conference call.
Absolutely.
Awesome.
Okay.
Thank you for your time.
Thank you.
Thank you.
Bye-bye now.
Thank you for joining us on this episode of Enlightened Wealth Strategies. We hope you found today's discussion insightful and inspiring.
If you enjoyed this episode, don't forget to follow and subscribe to our podcast. You can find us on YouTube, Apple Podcast, Spotify, or your favorite podcast platform to stay updated on new episodes.
Your financial journey doesn't end here. Connect with us online for even more resources and exclusive content.
Until next time, remember, financial enlightenment is just an enlightened wealth strategy away.
Investment advice is offered through Belpointe Asset Management, LLC, 500 Damonte Ranch Parkway, Building 700, Unit 700, Reno, Nevada, 89521. Additional information about Belpointe Asset Management is available on the SEC's website at www.advisorinfo.sec.gov. It is important to read our disclosures available at this link, www.belpointeasset.com, disclosures. The information provided in this presentation is educational and limited to the dissemination of general information. This material is not intended to be a recommendation of any kind, investment, tax, or accounting advice. Does not constitute a solicitation to buy, sell, or hold a security or an investment strategy. Engage in any financial transaction and is not provided in a fiduciary capacity. The information provided does not take into account the specific objectives or circumstances of any particular investor or suggest any specific course of action. Investment decisions should be made based on an investor's objectives and circumstances and in consultation with his or her financial professionals. While the advisor uses reasonable efforts to obtain information from sources believed to be reliable, the advisor makes no representation that the information or opinions contained in this material are accurate, reliable, or complete. All information and opinions contained in this material are subject to change without notice. The views and opinions expressed are for informational and educational purposes only as of the date of the production or writing and may change without notice at any time based on numerous factors such as market or other conditions, legal and regulatory developments, additional risks and uncertainties, and may not come to pass. This material may contain forward-looking information that is not purely historical in nature.
Securities offered through Fortune Financial Services, Inc., member FINRA and SIPC. Belpointe Asset Management, LLC, and Fortune Financial Services, Inc. are not affiliated. Past performance is no guarantee of future results. Investing involves risks. Principal losses possible.